If you are new to the exciting world of investing, you might have heard that you can invest in things like shares, property, bonds, cash, ETFs, unit trusts, etc. Now, although all of this might seem a bit overwhelming, it is quite easy to understand once you break it down. So in this video, I will go over exactly what a share is, what you need to consider when investing in shares, how you can invest in shares, as well as where the best places in South Africa is to buy shares. Now, this video forms part of the Investing for Beginners in South Africa series, so make sure to check out this playlist, which I will link to down in the description, and also consider subscribing to my channel so that you don't miss out on any future videos. Okay, so first of all, shares are exactly the same thing as stocks and equity. I know this is quite confusing, and heaven knows why they keep on making up different names for simple things. Anyways, a share at its core is basically a unit of ownership in a company. So, when someone starts a company, they generally need to raise capital to help fund their projects. Now, this can either be done by taking out a loan from the bank, which is not always ideal and rather expensive, or they can raise capital by issuing shares on the stock exchange. Now, a stock exchange is basically an online marketplace such as the JSE that we have in South Africa, where all the share prices of the biggest companies in the country are listed. So in essence, if you buy a share, you basically buy part of the company. Now, this sounds rather fancy, as you can then actually flex at your next braai by saying that you now own part of Amazon or Tesla, even though you might still be rather broke. Now, because you have helped the company raise capital by giving some of your own hard-earned money, the company will hopefully reward you in two basic ways. Number one, if the company grows and becomes more successful, then they will become more worth. And this will in turn raise the value of each one of its shares. And if you then decide to sell your share for more than what you paid for it, then you will make a profit known as capital gains. The other way is if the company pays dividends. Now, how this works, if a company turns a profit, they can either decide to reinvest the profit back into the company to help it grow, or they can make small payments to all its shareholders, which will be you, by means of a dividend payment. This is usually a certain amount of cents per share and can be paid once a year or multiple times, depending on what the company's board of directors decide. So when we say we invest in shares, we basically put money into a company with the hopes that the company will be successful and somewhere in the future give us back more money than we gave them. Now, share investing is generally seen as high risk, high return. This means that you have one of the best chances of making money, but also one of the best chances of losing all of your money. Just as the company may grow to become extremely profitable, so can it also go ballistic and fail, taking all your money down with it. The other reason for this is because of the nature in which the stock market works. You are invested with many other people, and the share price is therefore also influenced by demand and supply, as with most things. So when a company does well in a stable environment, meaning pre-COVID, then the share price will generally go up because people have confidence that they will have a good return on their money. And if you bought a share early on, you will in essence become richer, as your share value will also increase. But if the company goes down or there's a major global crisis, such as what happened with the coronavirus, then people will start panicking and sell off their shares to turn into cash, which is much more stable. So if there is a massive sell-off in a short period of time, then the markets will crash and you will lose a lot of money on paper because the value of your share came down. Now, it is important to realize that when this happens, these losses are only on paper, meaning it is only made real once you cash out your shares. This is what the smart people will call realizing your losses. So, as you can see, investing in shares comes with a lot of risk, but also have a lot of potential. And when you look all the way back to how the stock market performed since its inception, you can see that shares grew much more when compared to property, bonds, and cash over the long run. And that is the key when it comes to share investments. You need to be in it for the long run. Most experts will say for at least 7 years. Now, share prices tend to go up and down in the short term, also called being volatile, but this eventually evens out in the long term. Other benefits of shares are that they can be very liquid, meaning that if you need to get access to your money very quickly, you can easily sell off your shares, although this is not really advised when the markets are down. And lastly, shares can easily be diversified. You can either invest directly in shares in different countries, different sectors, and different categories, or choose unit trusts or ETFs that already has these built-in diversifications for you. Now, some potential drawbacks of share investing could include that shares are very volatile, meaning that they can go up and down based on things like economic, weather, and political factors. This makes them not so great for short-term gains. You could also risk losing most or even all of your money when you invest all your savings into a single share or company, kind of what happened to Steinhoff. It does take some degree of knowledge and time to analyze a company, their financial statements, as well as the market to make a well-informed decision on what to invest in. Just by being familiar with a company's name is not enough to risk all your money on it. And lastly, some stockbrokers will charge a hefty fee for investing in shares. Not all of them, but make sure you are at least aware of all the fees involved. And yes, even with investments, you still need to pay the taxman. No way avoiding that. So, on shares, you will need to pay local dividend tax, foreign dividend tax, and capital gains tax. If you want more info on how exactly this is calculated, then make sure to check out my other video over here in the info cards. Now, there are basically two approaches to investing in shares. The first one is active investing, which means you are actively trading shares on a very regular basis. And the second one is passive investing, which means you are buying shares or indices and basically leave it for the long run. Now, on top of this, there are also basically 4 main strategies to share investing. The first one is value investing. This is where you try and identify and buy shares that are undervalued. This is generally done by analyzing a company's financial statements and focusing on the price to book value. This is quite advanced and not really recommended for beginners. The second one is penny stock investing. Now, penny stocks are shares from very small companies that generally cost less than 10 Rand each. If you are lucky, some of these companies may take off and you will have a massive return on investment. But most of the time they will fail, as most startup businesses do. So this is seen as a very high risk strategy. And the third one is growth stock investing. With this one, you will invest in a company based on its intrinsic value that you believe it has, with the hopes that it will grow at a stable rate with its share price getting overvalued over time. And the fourth one is passive index investing. This is when you invest into ETFs or exchange traded funds. Now, these work by tracking an index, meaning the average growth of a bunch of companies according to a predetermined set of rules that defines when to buy and to sell. This may sound a bit complicated, but all it really means is that it will track certain indicators, such as, for example, the top 40 companies in South Africa, and if number 41's value increases above number 40, then number 40 will get booted and number 41 is included in the index. This type of investing is a lot less intensive for the investor and offer much more diversification than normal share picking investments. This is also my favorite type of investing strategy and something that I will recommend for anyone starting out. Now, when it comes to investing, you will need to have a well-defined strategy before even spending a single rand. Shares should definitely form part of your overall portfolio, but it will not be wise to put all your money into a single company. Echoing the proverbial putting all your eggs in one basket. The longer you plan to remain invested, the more of your portfolio you can allocate to shares. Now, buying shares in individual companies is rather risky, especially if you are like the average Joe, such as myself. In order to be successful with this, you will need to know what you are doing. You need to research the company that you want to invest in thoroughly, and you need to understand the market. This is often only advised for experts such as Warren Buffett, and even they get it wrong most of the time. So, if you do not have a career in asset management, then I would highly advise against investing into single companies. My advice obviously does not mean jack because I'm not a financial advisor, but from the research that I've done, you will have a much lower chance of hitting the jackpot than losing a lot of money. Because by the time that we, the average Joes and Janes, hear about these big hits in the media, it is probably already too late to jump in. So what I find to be much safer and easier to understand is to invest into ETFs or unit trusts that contain diversified assets, as your risks are then much better spread and you will have a higher chance of getting an inflation-beating return on your investments. Now, you cannot independently buy shares. You will have to find a stockbroker that is registered with the Financial Service Board who will purchase the shares on your behalf. You can therefore invest either through an investment broker or invest through a company platform such as Easy Equities that allow you to choose the shares yourself. Now, stockbrokers and financial advisors are trained and knowledgeable about the stock market and will be able to guide you as to where to put your money based on your risk profile, time frame and objectives. They tend to claim that they can outperform the market, but this is not always the case. You will need to decide if you would like the stockbroker to take on a full service role, which includes offering advice and managing your portfolio, or whether you simply want an execution only broker who never suggests what to buy or sell and only acts on your instructions. The former will obviously be more expensive, but they might be able to provide some solid insights into the best JSE shares to buy and how long to hold them for. If you are not really interested to invest time and energy to learn how the stock market works, then you would absolutely need to work through a broker. Just note that they do charge a fee for their services, rightfully so, but this can also eat at your returns over the long run. So if you use one, make sure that the advice, convenience and returns that you get through your broker will justify their fees. Now, if you have enough knowledge and confidence to invest yourself, then you can skip a financial advisor and invest directly with an online broker such as Easy Equities. This will save you a lot on costs, and they really do make an effort to make it as easy as possible for us normal Joes to invest our money. Also, almost all of the banks in South Africa offer a means to buy shares. So if you are unsure as to where to buy your shares from, keep it simple and buy them through your local bank. Now, I will leave a link down in the description to an article that compares all the different platforms with their respective fees if you want to check it out. Once you have chosen a broker or platform, you'll be required to fill out some paperwork and sign off some T&Cs. You might also have to submit FICA documents and provide proof of ID and residency. But don't worry too much about this. Most brokers try and make this process as easy and convenient as possible. And after you've submitted your paperwork and your account has been approved, you can start investing. Yay! Now, if you use a broker, you will generally need to choose between opening a discretionary or a non-discretionary account. Discretionary accounts allows brokers to make trades without your consent based on his belief or discretion on the best way to achieve the best investment returns with unacceptable levels of risk specified by you. This is a good option if you are only a beginner investor with a lot of money and very little interest to do your own research. If you want to make your own calls, then a non-discretionary account will be best, as you can then select for yourself which shares to buy. But guys, if you want to dip your toes into the stock market but you are still a bit afraid to use your own money, then you can always start with a demo account, such as what can be found on Easy Equities. This allows you to buy shares or ETFs just like you normally would and then see how they perform. This is a great way to familiarize yourself with the platform and to practice investing without taking any financial risks. So don't let all these weird acronyms and investment jargon put you off of investing. Opening a demo account with Easy Equities is absolutely free, and if you find that you hate it, then use a financial advisor. But if you feel that you enjoy it and you want to take charge of your own money, then take the leap and invest some real moolah. So to conclude, when it comes to share investing, you will need to know what you are doing, or else you might lose a lot of money. Remember, the stock market comes with risks. The outcome is never guaranteed. If you do feel brave and you want to buy individual shares, then buy at least 4 or 5 different ones to bring some degree of diversification to your portfolio. For most of us, buying a well-diversified ETF will work best, as it is a much safer and easier route to take. And most importantly, be patient. Investing is a marathon, not a sprint. Markets will fluctuate. You will see your shares drop, and this might stress you out. Remember that share investing is for the long term. So whatever you do, do not panic sell. Now this video hopefully gave you a proper overview of the basics of share investing, but if you want to learn more, there are hundreds of helpful resources available on the internet, such as on the Easy Equities and JSE website. So educate yourself and don't be scared. Investing can become quite fun, especially if you begin to understand how the industry actually works. Thanks for watching, guys. If you found this video to be helpful, then please leave a like for the YouTube algorithm. And if you want to learn more about other types of investments that are available, such as property, bonds, and cash, then make sure to check out this playlist over here. And if you're interested in personal finance, entrepreneurship, and investing, then consider subscribing to my channel so that you don't miss out on any future videos. Anyways, guys, that is all for today. As always, have a lucky day, and I'll see you in another video next week. Cheers.